For years, American Water Works was considered one of the safest long-term compounders in the market. A defensive business. Stable cash flow. Essential service. And a monopoly-like business model that many investors loved. But now, the stock has fallen sharply. From around $185 to nearly $123. So what happened? Did the business suddenly deteriorate? Or is the market simply repricing a once overvalued utility stock? Because sometimes, even great businesses can become bad investments when bought at the wrong price. In this video, we will break down why American Water Works stock has been under pressure, how interest rates are changing utility valuations, the risks investors need to understand, and whether ROIC is finally becoming attractive again for long-term investors. One of the biggest mistakes investors make is assuming that a great business automatically means a great investment. But in reality, valuation matters. Even the highest quality company can produce poor returns if investors buy the stock at an excessively expensive price. And for many years, that was the situation with American Water Works. Investors loved the company because the business looked extremely safe. Stable demand, predictable cash flow, recurring revenue, and long-term infrastructure growth. As interest rates stayed near historic lows, investors became willing to pay higher and higher valuation multiples for stability. Eventually, ROIC traded at a massive premium compared to most utility companies. But here's the problem. When expectations become too optimistic, the stock price can disconnect from the actual growth of the business. And once the macro environment changes, especially interest rates, valuation compression can happen very quickly. This is exactly what investors are seeing today. The business itself did not collapse. Water demand did not disappear. But the market is no longer willing to pay any price for defensive utility stocks. That's why understanding valuation is so important. Because long-term returns are determined not only by the quality of the business, but also by the price investors pay for that business. One of the most important concepts in investing is understanding fair value. Because no matter how great a company is, every stock has a price where it becomes attractive, reasonable, or overly expensive. Fair value is essentially the price investors believe reflects the true long-term value of a business. In other words, it is the point where expected return, business quality, growth, and risk become relatively balanced. The challenge is, fair value is not fixed. It changes depending on interest rates, economic conditions, growth expectations, and investor sentiment. During periods of low interest rates, investors are usually willing to pay much higher valuation multiples, especially for stable and defensive businesses like American Water Works. But when Treasury yields rise, the market often lowers the valuation investors are willing to pay. That's why a stock can fall significantly, even when the underlying business remains relatively stable. And this is where valuation discipline becomes critical. Because the goal is not simply to buy great companies. The goal is to buy great companies at reasonable prices. Sometimes, an amazing business can still deliver disappointing returns if investors overpay. While in other situations, temporary market fear can create opportunities to buy strong businesses closer to fair value. That's why many long-term investors constantly ask, is the stock price already reflecting too much optimism or too much fear? Now let's talk about how to read this ROIC valuation model. In this analysis, the valuation is divided into three different scenarios: conservative, historical, and optimistic. Each scenario uses a different PE multiple to estimate what the stock could reasonably be worth. The idea here is simple. Valuation is not an exact number. Instead, valuation is usually a range based on market expectations. The first layer is the conservative valuation. Here, the stock is valued using a PE multiple of around 20.5 times earnings. That gives an estimated value near $117 per share. This scenario assumes higher interest rates remain elevated, investors become more cautious, and the market is no longer willing to pay premium multiples for utility stocks. In other words, this represents a more pessimistic or risk-aware environment. For long-term investors, this level may offer a larger margin of safety. The second layer is the historical valuation. This uses ROIC's longer-term average PE multiple, around 26.7 times earnings. Based on that historical valuation, the estimated fair value is around $152 per share. This scenario assumes the company continues operating normally, while the market values the business closer to its long-term average. This is often considered the fair value zone, where optimism and caution become more balanced. The final layer is the optimistic valuation. Here, the market applies a much higher PE multiple, around 33.8 times earnings. That produces a valuation near $193 per share. This type of valuation usually happens when interest rates are low, investor sentiment is very positive, and the market aggressively rewards stable compounders. This was similar to the environment investors saw during the easy money era, when defensive quality stocks traded at extremely high premiums. But here's the key takeaway. Valuation is not about predicting exact prices. It is about understanding expectations. The lower the valuation multiple, the more fear and caution the market is pricing in. And the higher the multiple, the more optimism investors are willing to pay for. Right now, the market appears far more cautious toward utility stocks, especially because higher Treasury yields are pressuring premium valuations. That's why many investors today are focusing more on margin of safety, valuation discipline, and long-term risk versus reward. So, what exactly is American Water Works? American Water Works is the largest publicly traded water and wastewater utility company in the United States. The company provides clean water, wastewater treatment, and related infrastructure services to millions of customers across the country. In simple terms, AWK operates one of the most essential services in modern society: delivering water. The company manages water treatment plants, underground pipelines, pumping stations, storage facilities, and wastewater systems. And unlike many industries, water demand is incredibly stable. People still need water regardless of economic conditions, inflation, recessions, or market volatility. That makes the business naturally defensive. Another important reason investors pay attention to ROIC is because the company operates under a regulated utility model. This means the company invests billions of dollars into infrastructure, while regulators allow ROIC to earn a reasonable return on those investments over time. So as the company upgrades pipelines, expands water systems, and modernizes infrastructure, those investments gradually become part of its regulated asset base. And because building water infrastructure requires enormous capital and decades of development, competition is very limited. In many areas, water utilities effectively operate like regional monopolies. That combination, stable demand, recurring revenue, essential services, and monopoly-like characteristics, is exactly why many investors once considered American Water Works one of the safest long-term compounders in the utility sector. But as we'll discuss later in this video, even great businesses can face significant stock price pressure when valuation and macroeconomic conditions begin to change. For many years, American Water Works became one of the market's favorite defensive compounders. Investors were attracted to the company for several important reasons. First, the business operates in one of the most stable industries in the world. Water is not optional, regardless of economic conditions, inflation, recessions, or market volatility. People still need clean water every single day. That gives ROIC a very predictable demand profile. Second, the company generates relatively stable and recurring cash flow. Because American Water Works operates under a regulated utility model, revenue tends to be more predictable compared to many other industries. Investors value that stability, especially during uncertain economic periods. Third, ROIC has long been viewed as a high-quality infrastructure business. The company continuously invests in pipelines, treatment facilities, and water system upgrades. Over time, these investments expand the company's regulated asset base, which helps support long-term earnings growth. Another major reason investors loved ROIC was the company's defensive reputation. During periods of market stress, many investors preferred stable utility businesses rather than highly cyclical companies. And during the low-interest rate era, that appeal became even stronger. When Treasury yields were extremely low, investors searched for businesses that could offer reliable growth, recurring revenue, and dividend stability. American Water Works fit perfectly into that environment. The company was often viewed as a safe long-term compounder, a defensive investment, and in some ways, even a bond alternative. As a result, investors became willing to pay increasingly higher valuation multiples for the stock. And eventually, that premium valuation became one of the biggest reasons the stock later experienced significant pressure. Because while the business remained strong, market expectations had simply become too optimistic. So, if American Water Works is still a strong business, why has the stock fallen so much? The biggest reason is the macro environment. For years, ROIC benefited from extremely low interest rates. Investors were willing to pay very high valuations for stable and defensive utility stocks. But when inflation surged, Interest rates moved sharply higher, and Treasury yields became more attractive. That changed investor behavior very quickly. Utility stocks like American Water Works are often viewed as bond-like investments. So when bond yields rise, investors become less willing to pay premium valuations for slower-growing utility companies. This led to valuation compression, which became one of the main reasons behind ROIC's decline. Another important factor is the company's large infrastructure spending. ROIC continues investing billions of dollars into pipelines, treatment facilities, and system upgrades across multiple regions in 2026. While these investments may support long-term growth, they also increase financing needs in a high-interest rate environment. And that has created additional short-term pressure and negative sentiment around the stock. But importantly, the business itself did not collapse. Water demand remains stable. The company still operates essential infrastructure, and long-term fundamentals remain relatively strong. So this may not be a story about a broken business. Instead, it may simply be a case of a great business facing bad timing. Now let's look deeper into the financial quality of American Water Works by comparing FY 2025 with FY 2024. And interestingly, while some areas remain stable, several important indicators also show increasing pressure from the current macro environment. First, let's start with gross margin. In FY 2025, ROIC reported a gross margin of approximately 60.72%, slightly higher than 60.33% in FY 2024. This tells us that the core business itself remains relatively stable and efficient. Even in a challenging environment, the company still maintains strong profitability at the operational level. That's one reason why many investors still view ROIC as a high-quality utility business. Next, let's look at return on invested capital, or ROIC. In FY 2025, ROIC was around 5.94%, almost unchanged from 5.93% in FY 2024. This suggests the company is still generating relatively consistent returns from its infrastructure investments. However, the concern today is not only ROIC itself, but whether those returns are high enough compared to the company's rising cost of capital. Especially in a higher interest rate environment, investors are becoming much more sensitive to capital efficiency. Now, one of the most important areas investors need to watch: free cash flow. In FY 2025, ROIC reported an FCF margin of negative 23.15%. compared to negative 21.37% in FY 2024. In other words, free cash flow became even more negative. This reflects the company's massive infrastructure spending, including pipeline replacement, treatment facilities, and long-term system upgrades. While these investments may support future growth, they also increase financing needs and pressure short-term cash generation. And in today's environment, the market is paying much closer attention to companies with persistently negative free cash flow. Finally, let's examine interest coverage. In FY 2025, ROIC's interest coverage declined to around 3 times, compared to 4 times in FY 2024. This is important because it shows rising interest expenses are starting to put more pressure on the company's earnings. The business itself remains stable, but higher borrowing costs are reducing financial flexibility. And for a capital-intensive utility business, interest rates matter significantly. So overall, the financial picture here is mixed. Operationally, the business remains stable. Margins are still strong, and ROIC has remained relatively consistent. But at the same time, negative free cash flow, rising financing costs, and weaker interest coverage help explain why the market has become more cautious toward the stock. And this is exactly why investors today are focusing not only on business quality, but also on capital efficiency, balance sheet risk, and long-term return versus cost of capital. After discussing valuation pressure, rising interest rates, negative free cash flow, and higher financing costs, the next question becomes very important. Is the business itself still strong? And honestly, I think the answer is still largely yes. At its core, American Water Works still operates one of the most defensive businesses in the market. Water is not a discretionary product. People continue using water regardless of recessions, inflation, geopolitical uncertainty, or economic slowdowns. Demand remains highly stable, and that gives the business a very predictable revenue base. Another important strength is the company's regulated utility model. ROIC invests heavily in infrastructure, and regulators generally allow the company to recover those investments over time through approved rate structures. This creates recurring revenue, relatively stable cash flow, and long-term visibility for the business. And because water infrastructure is extremely expensive and difficult to replicate, competition remains very limited in many regions. The company also continues investing aggressively into pipeline replacement, system modernization, and expanding infrastructure across multiple states. While these projects create pressure on free cash flow in the short term, they may also strengthen the company's regulated asset base over the long run. But this is where investors need to stay balanced. A strong business does not automatically mean the stock is cheap. Right now, ROIC still faces several important challenges. High capital requirements, rising financing costs, negative free cash flow, and pressure from higher Treasury yields. So even though the business fundamentals remain relatively stable, investors still need to think carefully about valuation and risk versus reward. And perhaps that's the most important takeaway here. This does not look like a broken business. Instead, it looks more like a high-quality company operating in a much more difficult macro environment. Now, despite being a high-quality utility business, American Water Works still faces several important risks that investors need to understand. And perhaps the biggest risk today is interest rates. Utility stocks are highly sensitive to Treasury yields and financing costs. Because businesses like American Water Works require massive infrastructure spending, the company depends heavily on long-term capital and debt financing. So when interest rates rise, borrowing costs increase, financing becomes more expensive, and valuation multiples often come under pressure. Another important risk is the company's negative free cash flow. ROIC continues spending billions of dollars on pipeline replacement, treatment facilities, and infrastructure modernization. These investments may support long-term growth, But they also create pressure on cash flow in the short term. And in today's market, investors are becoming much more cautious toward businesses with rising financing needs. Regulatory risk is also important. Because water utilities operate under regulated pricing structures, the company cannot freely increase prices whenever costs rise. Regulators ultimately decide how much return the company is allowed to earn. So if costs rise faster than approved returns, profitability could face additional pressure. And finally, valuation itself remains a major risk. Even great businesses can deliver disappointing returns if investors pay too much. That's why understanding both business quality and valuation discipline is extremely important for long-term investors. So after looking at the business, valuation, financial performance, and macro risks, what can investors take away from American Water Works? First, this still appears to be a high-quality business. The company operates one of the most defensive and essential services in the economy. Water demand remains stable. Competition is limited. And the regulated utility model provides relatively predictable long-term revenue. However, the market environment has changed dramatically. Rising Treasury yields, higher financing costs, negative free cash flow, and valuation compression have all created significant pressure on the stock. And that helps explain why ROIC has fallen so sharply from its previous highs. But perhaps the most important lesson here is this: a great business does not automatically mean a great investment. Valuation still matters, especially in a higher interest rate environment. Investors need to pay much closer attention to cost of capital, balance sheet risk, and long-term return expectations. At current levels, ROIC may look far more attractive than during the premium valuation era. But investors still need to remain disciplined, patient, and realistic about both the risks and the potential rewards. Because in the end, this may not be a story about a broken company. Instead, it may simply be a case of a great business facing bad timing. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.